For now, credit conditions have tightened. The labor market has loosened. GDP has come down, which no one was really positioned for. And I think and you've got some more dovish members now with Goolsbee talking some sense after the Fed has basically rammed the truck through the wall and started to break things. You have some voices of reason coming on board and saying, hold on. Let's just take a breather here and see how this works on a lag basis before we absolutely throw the economy off the cliff, which it could be teetering on if they keep pressing.
Stock markets are rebounding on Thursday on the back of strong earnings releases from tech companies, but GDP came in lower today and another gray cloud looms. So what does this all mean for markets going forward, and how should investors be positioned right now? Joining me to discuss these issues is Thomas Hayes, managing member of Great Hill Capital. Welcome, Thomas, to my show. Pleasure to have you today on the David Lynn Report.
Thanks for having me, David. Glad to be back.
So this big cloud I was talking about, let's talk about it first. First Republic Bank, stocks continue to sink lower. And the question is whether or not it's going to get bought out. It hasn't found a buyer yet, or it's going to get absorbed by the government. What do you think is going to happen next?
Well, it's basically sitting in the fetal position like a wounded duck, and no one wants to pull the trigger. I think what you basically have here is a bank with a ton of uninsured deposits. They had very chunky, ultra high net worth deposits, which knew once they smelled a little bit of whiff of trouble, they all fled immediately. And it's going to be very difficult to find a buyer because the buyer will have to raise a lot of equity capital against the underwater assets. So I think the most likely scenario, David, is that we're going to see a forced marriage backstopped by the government. Like you saw with Credit Suisse and UBS, where the government will have to come in with taxpayer dollars to backstop it and make it worth the larger bank's while. Barring that, more likely than not, it goes into receivership. But this has been a big overhang on the market. So, we've had really blowout, fantastic earnings, especially just this week with tech, well better than feared, well better than expected. And I think that's kind of put the market at ease. And you really just have this overhang because the longer it lingers out there, the higher the chance of contagion and the higher likelihood that the Fed will ultimately have to come in, believe it or not, and either temporarily or permanently backstop all deposits. So they need to get this wrapped up potentially over the weekend, more likely than not, either take it into receivership and call it a day, or do a forced marriage and backstop it with some government guarantees and on to the next so we can move past this. Because when you look at the other ones that I continue to keep on my dashboard just to give me a sense of where the market's going, Pacific West Bancorp is doing well. Their deposits actually went up. Western Alliance is doing well. So all the ones that were at risk on the West Coast seem to have weathered the storm much better than First Republic. And that has to do with the lumpy deposits, which was a similar situation with SVP.
But the remaining deposits at FRC aren't at risk?
Well, it depends. It's according to Warren Buffett, who's not going to actually be the one to step in and backstop it. I would say more likely than not, the government would backstop them as an implicit guarantee. But, if I had uninsured deposits there, I would probably be spreading them out a little bit and taking a little bit of precaution because the FDIC insurance right now is $250. I think that is too low. I do think that the executive branch has the ability to act unilaterally in times of crisis, despite everyone saying it'll take too long to work through Congress. And they could do a 24-month backstop until they could get the formal limits increased through Congress. And that would solve the vast majority of the problem. But to date, we still have 45% of deposits in this country that are uninsured. So you have seen money flee into the systemically important banks, which are Bank of America, Wells Fargo, Citi, JP Morgan, et cetera. And you've also seen a ton of money move into money markets because particularly treasury-backed money markets and in some case commercial paper money markets as well. So that's the state of affairs. But, this hanging out in purgatory helps no one. And I think the Fed needs to take some action here.
All right, so let's finish up talking about the banks. We'll move on to earnings and your market outlook. So you mentioned that the Federal Reserve may put a surprise pause on rate hikes next week due to a number of potentially unforeseen factors. What could they be?
Well, I think that you have this banking crisis still alive. I mean, we're 4, 5, 6 weeks into this, and we still have no resolution. So you're seeing a contraction in lending to businesses on the commercial side. So you're seeing a tightening of credit the longer that this drags on. You are seeing some deposit flight in regional banks continuing to a greater or lesser extent, depending on the banks. And lending, and a lot of fear about obviously commercial real estate, because if you think about these regional banks, what are they? They're in B and C property regions, not A property regions. Not all REITs are created equal, but the commercial real estate that is in the B or C, I would liken it to the mall crisis of 4 to 5 years ago. If you remember, everyone said there were going to be all these ghost malls and the B and C properties were going to be toast. And they were absolutely right. The B and C malls were toast. But the A malls did even better than ever. If you think about Simon Property Group, they have the Apple stores, they have the Lululemon stores, the upscale malls did great. I think the same is going to be the case with commercial property, and particularly office property. You saw Boston Properties beat this week, top line and bottom line, doing much better than people expected. SL Green was out. You're going to have Renato report on Monday. That's going to likely surprise people to the upside as well. So with the A properties, the best of the best, I think they're really undervalued here, and they're going to be opportunities moving forward when you look out 12 to 18 months. With the B and C, I think you have trouble, and that's going to force the Fed's hand as these loans need to be rolled to be more dovish. So my bet, look, you look at the Fed funds future, it's still at 75-80% odds of a hike next week. That's kind of priced in. They wanted to get to 5.1 on the terminal rate. That would get them there. So I think, you probably see that for sure. But I do think at that point, the surprise might be, and we're going to pause for now and leave rates elevated for some time and see how the market absorbs it. We reserve the right to raise again. But for now, credit conditions have tightened. The labor market has loosened. GDP has come down, which no one was really positioned for. And I think and you've got some more dovish members now with Goolsbee talking some sense after the Fed has basically rammed the truck through the wall and started to break things. You have some voices of reason coming on board and saying, hold on. Let's just take a breather here and see how this works on a lag basis before we absolutely throw the economy off the cliff, which it could be teetering on if they keep pressing.
So like you mentioned, GDP it came out today. Advanced Q1 GDP estimates came out, and it did come down, like you said. Did this change your positioning from an investment standpoint at all?
No, it just pulls forward the pause. So I think prior to this print, you started to see baked in 25 this month, but you also started to see people saying maybe one more coming again in June as things were humming along. I think with this type of print and with some of the initial jobless claims and continuing claims that we've been seeing, and the jobs report that we've seen, and the headline inflation, tomorrow we get core inflation, which will be the most important data point before next week's meeting. Of course, would like to see that come down closer to 4. I mean, maybe even below. The big thing with inflation has been the owner's equivalent rent, which is such a big component of GDP, of CPI, that it's starting to show up, leases on a 12-month basis, on a lag basis from last year's high base effects. Rents are rolling over. You've seen all the data, David, whether it's Zillow rents, Redfin rents. So those are going to start to show up majorly, in a major way, in May, June, and July. Not in time for next week's meeting, but certainly in time for June. So the Fed may be done, and that's going to have broad implications, done meaning a hike and done, broad implications for the investment landscape. Namely, the dollar has been sniffing that out since October. The dollar is down some 13%. That's going to continue. And if they're done, I think you are going to see a regime change where emerging markets are going to start to get bid. They've been left for dead, largely as a function of the strong dollar in the last couple of years. But if that dollar downtrend continues, I do think you're going to see more and more assets flow into emerging markets, and the opportunities there on a relative valuation basis, and then obviously on a currency basis. Because if you look at the correlation over the last few decades, when the dollar weakens, emerging market equities rally.
Emerging. Are you long emerging markets equities then? Is that sort of a short play on the U.S. dollar as well?
It it we are long emerging markets through one large position that we've had for some time and been adding over the last year, which is a company called Alibaba, which they're breaking it up into six parts to unlock the value. This business is there's not a lot to think about here. You've got a business that's trading at 2014 IPO prices. And in the meantime, they have grown revenues 800%. They've grown cash flow and earnings by 500%. You got smoked with the regulatory overhang and the crackdown and the lockdowns all in 1 year, three 1 in 100 year events all at once. That's changed. And what you're seeing, we're going to see earnings in a handful of weeks. For instance, their e-commerce business is about 50% clothing and apparel. And what we've seen from the producers of a lot of that in China and competitors like VIP shops, et cetera, is that the Q1 numbers are absolutely through the roof. And the estimates embedded in the business are that the trends created by the 1 in 100 year lockdown events are going to persist in perpetuity. We think this is trading at somewhere around a third of intrinsic value. To give you an idea, they have this business called Preshipo, which investors assigned basically zero value to. It could effectively be the Costco of China. And they're going to be IPOing that piece of the business alone for $10 billion. Most investors had never even heard of it. Then you've got the cloud, you've got the digitization of China happening. The cloud business is going to, as an industry, according to McKinsey, is going to triple by 2025. Alibaba has 36% market share. And what they're doing right now is they're cutting price to grab share because it's the razor blade business. You know, if you think about, they basically give away the razors so that you keep buying the blades where all the margin and where all the money is. And that's exactly what Alibaba is doing right now. As the largest player, they can just crush all their competition. If you look at the web traffic, the traffic to Aliyun.com, which is their website, it's up 89% in the last 30 days, and everyone's pessimistic about Alibaba. It's pessimistic about their earnings. I'm seeing the apparel sales in China. The GDP shot the lights out, causing major banks to have to take up their GDP estimates now from 5% to 6% for this year. And that's going to be a massive growth driver, not only for China and Alibaba, which is the proxy for and the toll taker for Chinese growth, but for actually the S&P earnings in the back half. If you think about multinationals and the currency headwinds that they've had for the last 2 years, that's going to help earnings. China's opening is going to help earnings, which is why Europe has dodged a recession that everyone was certain was going to happen 4, 5, 6 months ago. And a lot of good things are happening. But we think not having emerging markets weight at this juncture is going to be cause for underperformance as you look out 12 to 24 months. So that's a position that we've consistently built. Every time it gets weak, we add, and that's going to be a monster over the next 12 to 24 months.
All right, thanks for that. Let's talk about U.S. stocks now. Let's bring it back home. What's your outlook for the stock markets for the remainder of the year? Earnings this week, like we mentioned, a lot of big tech companies beat expectations. Did it surprise your expectations? We've got a confluence of factors going on. For one, the consumer confidence index fell to a 9-month low. Data came out earlier this week. So forward looking, I guess people are feeling less confident about spending, but the earnings surprises to the upside show that the last quarter people were spending a lot of money, except Apple. Apple earnings haven't come out yet, but Mac sales dropped 40% in quarter one. And so, putting all these forces together, Thomas, do you think that these earnings strength or the strength in earnings that we're seeing this week can continue into Q2, Q3 and beyond?
Yeah, I think the tech weakness is in the rearview mirror. I think they've taken aggressive action to cut costs. Even with all the cuts that you've seen in tech in Q1, they're barely back to pre-pandemic levels. In other words, they haven't offset all the hiring that they did during COVID. And in many cases, they were hiring these people and putting them in a closet just so their competitors couldn't hire them. I mean, it's comical when you think about it. So considering the amount of weight that the top 5 or 6 tech companies are in the S&P 500, and the fact that they've acted quickly, we do think that not only are you going to see them able to sustain these, but actually grow. What was surprising, what everyone feared, was the enterprise spend, software as a service spend, and cloud spend. And Microsoft and Google more or less alleviated those fears. And if anything, not only stopping the level of deceleration, but actually a potential back half reacceleration of the cloud, of software as a service, of enterprise spend. And considering the weights and the earnings power of those companies, even if the regular economy slows, these businesses can carry the day. Plus, you consider 50% of revenues overseas for the aggregate of these bigger companies. With the dollar weakening, that's going to be further juice. So just as the stock market's a discounting mechanism, as you know, just as the stock market discounted the slowness that we're seeing today 6 to 12 months ago in October and in June with a 25-27% peak to trough decline, I think what you're going to see here as we move into June, we're 6 months out from 2024. Even if S&P estimates of $246 are a little bit high and they come down to 240, or even reaccelerate when you consider the dollar and you consider some of the enterprise spend coming back in, as much as looking at today's earnings, the market feels fully valued. When you look at forward earnings, there is opportunity, and I think this can push higher. I think it can also push higher meaningfully because of positioning. One of the data pieces that we look at extensively, David, is the Bank of America Global Fund Manager Survey, which you probably saw last week for the month of April. You have managers are more overweight bonds relative to stocks than they've been at any point in time since the lows in March of 2009. Those were the great financial crisis lows. So the pessimism is at those levels. You have growth expectations, the lowest that they've been since the March 2009 lows and the pandemic lows. You have risk levels. The amount of risk that managers are taking are at the same levels as the March 2009 lows. And I don't think we're anything like that. And then finally, you have real estate pessimism at the lowest levels they were since the 2009 lows. Now, what was the problem in 2009? It was residential real estate, right? Now, if you had bought residential real estate during that crisis, when pessimism was at its highest point, you would have done quite well buying a lot of residential real estate in March of 2009. This year, the problem is perceived to be commercial real estate. And we look at some of these businesses like Vornado, that is A class, not B and C. We're not touching the B and C stuff, but the A class properties, they are trading at just above great financial crisis low levels. And, if demand for Park Avenue, Madison Avenue, Fifth Avenue, Sixth Avenue in New York City, the best buildings in the greatest city on the world, goes out of favor, then we have a lot more to worry about than Vornado or Steve Roth, one of the best real estate operators in the history of commercial real estate, betting on the jockey there. So we like these asymmetric opportunities, and we like that managers are so pessimistic because the markets don't top when managers are overweight bonds and cash. They top when everyone is overweight equities and overweight equities on margin, and there are no marginal buyers. So while there are things to worry about, like the debt ceiling, like the Fed, like the banking crisis, the market is climbing a wall of worry, and the market never creates an opportunity where everyone is in cash. The consensus is everyone is in T-bills. I'll just get paid to wait. And when the market drops 20% more, I'll go in and buy equities. And that's not just quote unquote, sophisticated investors. Go ask your Uber driver if they're in cash or stock. And I can tell you they're all in cash and they're saying, once it drops to 3,500, I'm going to buy all these stocks. And when that happens, the pain trade is up. And all these people are going to be forced in at new highs, whether that's 6 months, 12 months, or 18 months down the road. They're going to be forced in. And not only have they missed the 17% rally off the October lows, they're going to miss the next 20% upside.
I'm going to come back to that, but let's just talk about smart money positioning here. I was reading a note earlier this week. This is from the Commitment of Traders report. And it revealed that I'm just going to read this note. The number of net derivative contracts on the U.S. 10-year note, so U.S. Treasury 10-year, dropped to a record negative 1.29 million in the week ending April 18th. Hedge funds are increasing their short bets on U.S. Treasuries. This is the largest bear position on U.S. Treasuries in a while on record, actually. So, what's the sentiment right now? Is that a bullish position on equities, or is that just risk on or risk off? Yeah.
No, that's absolutely perfect, as a matter of fact, because large speculators and hedge fund positioning and commitment traders is often a contraindicator historically. So what they're all betting on is that the Fed is going to go longer and more aggressively than we think is going to be the case. And that's how they're positioned. In other words, bonds down, yields up. They're short bonds. Historically, this has been an acute point where the exact opposite happens. Speaking to your point about commitments of traders, because this is something that we follow very intently, hedge funds are also the shortest they've been for over a decade, going back to 2009 again, in terms of S&P futures, in terms of Russell futures, they're very short, in terms of even Dow futures. So, and usually when they get short, if you want an indicator as to a more predictable indicator, and it depends on instrument by instrument, but you follow the commercial hedgers, and they tend to be early and they tend to be right. Commercial hedgers are getting aggressively long the S&P, aggressively long bonds, which implies a compression in yields and normalization. And that would actually follow with our bullish thesis, where with rates normalizing, the Fed pausing, the dollar weakening, earnings coming back, and a reacceleration in the back half, which the market is sniffing out, and that would force the market higher and push all these people in cash back into the market at the exact wrong time. So we think a lot of the stars are aligning for the wall of worry to continue to climb the wall of worry. We did get a hair overbought in the short term. We had that move off the lows in March. So we're kind of consolidating here, waiting for direction. And now it looks like pushing back through today after we got through what everyone feared, which was tech earnings. And they came in so much better than expected, and people just simply weren't positioned for it.
So I'm guessing today's rally had more to do with tech earnings than the lower GDP data.
I think unequivocally. I think certainly the lower GDP data, you didn't want a 3% hot number going into a Fed meeting, right? and come through the other side with a 50 basis point hike. That would be devastating for the stock market. But that was kind of already known, David, in that yesterday or the day before, Atlanta GDP now took their Q1 estimates down from 2.5 to, I think, 1.1 or 1.0. So the market kind of knew that, and it was soft in recent days following the First Republic saga that never ends. So no, I think this is a function of earnings. I think this is a function of some of the guidance, some of the rhetoric coming out of managements, and just seeing beats across the board, whether it's the big banks. Certainly the smaller banks were a little bit of a weight. Tech, some of the industrial companies. I mean, across the board, it's just, even if they're not taking guidance up, they're not taking it down. We didn't have the pre-announcements, which I was talked about quite a few times before the earnings season started. I said, I just don't think it's going to be that bad. We haven't seen any pre-announcements, and banks are going to report in a few days. And that's been the case. They're not taking down the guidance. Some of them aren't taking it up, but they're not taking it down. And that is much better than expected. And as they say, David, the secret to happiness in life is low expectations. And that's certainly what we came into this earnings season with.
I think Warren Buffett had a similar quote about marriage, but that's another topic. Thomas, let's finish up on your expectations for the Fed and then finally markets. So how many more rate hikes are we getting this year after next week?
I think that's it. I think it's going to be one and done. I think they're going to get to their terminal rate. What would be beautiful if this thing is still lingering? I mean, if they get First Republic resolved over the weekend, then they might have an impetus to raise and say, we'll see what happens next, see you next month. But if that thing is still lingering and lending at these regionals is contracting, you see it in the numbers. The surprise would be if they said, we hit our terminal rate, We're now at an elevated level. We intend to stay at an elevated level for the foreseeable future. We reserve the right to hike again if inflation resurfaces. But for now, we're gonna take a pause and see how this works through the system, as the data is already showing us that things are slowing, both in the labor market is loosening, which was our intent. Wages are decelerating, which was our intent. Rents are decelerating, which was our intent. So we have mission accomplished and reserved the right to go back to the well. I think the market would be very surprised. And what makes me think that that's a reasonable probability is the way that no one is positioned for it. And that would be maximum pain, given the amount of cash and the amount of people in treasuries that would have to scramble up 5, 6, 7%.
Finally, I have to ask you about the big bad R word and how you think that's going to affect your outlook and your positioning. You mentioned you're still long this rally. At what point would you change your bullish sentiment? Recession, would that have anything to do with it, or perhaps Fed surprise to either direction? Any catalyst for a reversal in your position, Tom?
Yeah, well, I think that the correction of last year priced in a mild recession already. So it would have to be something dramatic, like, and I wouldn't count the Fed out. They've already gone too far in terms of one of their tools, which is interest rate hikes. I've said for a long time they should have stopped at 3.5% and unwound $400 or $500, $600 billion off the balance sheet, and they could have drained liquidity that way and kept rates at a reasonable level and affected the same slowdown, but not locked 80 million millennials out of the housing market when they're just starting family formation. So, we buy businesses. I don't buy the market. I don't bet, is the market going up? Is the market going down? I pay attention to that because it impacts when I enter the businesses. But the businesses that we own have such a margin of safety at the levels that we've purchased them. It would take an awful deep slowdown. And I think, by the way, we already got it last year. We had a technical recession in Q1, Q2. We had the bear market. We had the correction. It's unlikely, if you look back since 1950, to go this long without retesting the lows. It's very low probability that that we go back down. So I think on balance, you can kind of feel it in the economy. Yes, you're seeing a slowdown in numbers and all of that, but on balance, it almost feels like we've had this rolling recession sector by sector for the last, kind of call it, since Q1 and Q2 of last year. Whether it was tech in the back half of the year. I think you're just getting to the end of the semiconductor recession or depression, which was the pull forward of PCs and servers a couple of years ago during COVID. As you referenced, 40% MacBook sales down. I think we may be at peak inventories as it relates to that. It'll be very interesting to see what Intel has to say tonight. It may take them another quarter. Maybe peak inventories is not this quarter. Maybe it's next quarter. But I think we're getting close now. And on that basis, historically, unless the Fed really destroys things, which now they've got cover that they can pause if they want to, I think the more likely outcome is everyone's looking for what can go wrong. I think there are very few things people are looking for what can go right, and there are quite a number of things that are set up that point to a better back half and certainly first half of next year.
Finally, you have an excellent newsletter. Hedge fund tips. Everybody should follow that. Tell us about that and where we can follow your work.
Well, thank you. Yes, it's hedgefundtips.com, and you can go on there and put your email in. You'll get our daily newsletter. But more importantly, on a weekly basis on Thursdays, we put out a research note every week, which has a wide following among institutions, hedge funds, journalists, ultra high net worth, and regular traders and investors. And also on Thursdays, we put out our weekly videocast podcast, which has been going for about 3 years now. I think we're on episode 184 today. And it's actually ranked number 1 in the hedge fund category by FeedSpot, albeit it's a small niche, but we are number 1 and we're proud of that. Grateful for that more than anything else. And I think people will get a lot of value if they like that particular style in the market. We take Ask Me Anything questions from the audience. We go through different companies. It's all opinion, not advice, of course. And I think people find that very valuable. And that's the feedback we've been receiving consistently.
Yeah, I do have one final question to close off our conversation since you're talking about tips, hedge fund tips. This is more of a tip for the younger audience watching and who want to or aspire to work at a hedge fund after college. What should they do in their early days in school? How should they prepare for this career?
Yeah, I think there are a lot of different ways to get there. The number one thing I would suggest for people who like valuing businesses and investing in companies and buying things at a discount, start to read for the CFA. I think that's the most important thing you can do. If you want to go more the trading route, I don't know the exact route that you would take for that, but I think if you learn about how to value companies, that's going to serve you well in your life, in your career, in getting your foot in the door, and that'll put you probably 5 years ahead just by getting that information all at once versus having to learn it over time. And alternatively, you can go the investment banking route and learn how to do models for 3 years and then either wind up in private equity or in a hedge fund. But either way, you've got to learn the basics. That's table stakes. So I think the CFA is probably a more direct path, or you could go work for an investment bank. But you need some type of training to get in. It's not just going to your favorite, clothing store or burger store and say, wow, this is a great business. We should invest in it. It takes a level of analysis, a level of training. And then from there, you just learn from experience over and over, and you work harder than anyone else as an investment in your own future. And if it's appreciated by your current employer, you're going to get more compensation. And if it's not, you're going to get it elsewhere. And that would be my biggest suggestion, is always do more than you're paid for as an investment in your own future. And sooner or later, the compensation will catch up with the work. And more than anything else is compounding that knowledge over time, because that's where the real value is to be had, and that'll set you up for an incredible life. So that's my best tip.
I think that's advice for any career, not just hedge funds. But thank you for that, Thomas. And on that note, we'll end it here. Hedge fund tips. Follow Thomas at hedgefundtips.com. Thank you for your time today. Appreciate it.
I appreciate it, David. Thank you.
And thank you for watching my channel. Don't forget to subscribe.